Welcome to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamowen. Today we've got a lot to cover, including what the Bank of Canada's recent rate hold could mean for you, the rising mortgage debt that's delaying retirement for many Canadians, and some promising trends in the housing market. But first, let's dive into our top story. The Bank of Canada just announced its third rate cut this year. So, the Bank of Canada has just made its third rate cut this year, bringing its overnight lending rate down from 4.5% to 4.25%. This comes after two consecutive cuts earlier in the year, one in June, which brought the rate from 5% to 4.75%, and another in July, which reduced it further to 4.5%. According to Leslie Preston, the managing director and senior economist at TD, this latest 25 basis point cut signals that the Bank of Canada is in a cutting phase. Inflation and the job market are cooling down, which is what the central bank wants to see. The Bank of Canada aims for an inflation rate of around 2%, and things seem to be moving in that direction. Preston mentioned that inflation is cooling in Canada. In fact, the latest data from August showed that inflation slowed further in July, bringing headline inflation to 2.5%. That's the lowest level we've seen since March 2021. This is exactly the kind of progress the Bank of Canada is looking for toward its 2% inflation target. In its decision to cut the overnight lending rate, the Bank of Canada stated, "With continued easing and broad inflationary pressures, the Governing Council decided to reduce the policy interest rate by a further 25 basis points. Excess supply in the economy continues to put downward pressure on inflation, while price increases in shelter and some other services are holding inflation up." So what does this rate cut mean for Canadians? The Bank of Canada's lending rate serves as a reference point for financial institutions to set interest rates for products like mortgages and loans. When the overnight lending rate goes up, it becomes more expensive for Canadians to borrow money. Conversely, when it goes down, borrowing becomes cheaper. For Canadian homeowners with variable rate mortgages who have fixed payments, a lower rate means a higher proportion of their payment will go toward the principal amount of their mortgage. Homeowners with variable payments will see their total payment shrink. However, it is important to note that this rate cut may not significantly impact fixed mortgage rates. These are usually priced based on government bond yields, and financial markets had already anticipated this rate cut, factoring it into bond yields. Leslie Preston pointed out that since a 25 basis point cut was expected by the markets, it was already factored into bond yields. Therefore, we are unlikely to see a big shift in bond yields or in the fixed mortgage rates currently available in the market. Looking forward, there are two more scheduled Bank of Canada rate announcements this year, one on October 23rd and another on December 11th. TD Economics predicts that more rate cuts are on the way. They expect the Bank of Canada to continue with quarter-point cuts at every meeting through the remainder of the year and into 2025. Andrew Hensich, another economist at TD, mentioned that the central bank's announcements are data-dependent. So, they look not only at inflation but also at data from the job market and the overall health of the economy when making rate decisions. According to Hensich, longer-term interest rates have already come down about half a percentage point since late April, indicating that the market expects rates to continue to fall. TD Economics forecasts that the Bank of Canada's rate will be cut to below 3% by the end of next year. So we could see the current 4.25% overnight lending rate drop to 2.5% by the end of 2025. This could provide some much-needed relief for borrowers and stimulate economic growth. Rising mortgage balances and higher interest rates are making it harder for some to retire as planned, according to new data from Statistics Canada, StatCan. The National Statistics Agency's report showed that in 2023, more than 1 in 8 Canadians, or about 13.1% of the population, were aged 55 to 64, putting them on the cusp of retirement. However, financial pressures may force many to delay this milestone. Higher interest rates have significantly raised the cost of living for Canadians, particularly for those carrying mortgage debt. Mortgage liabilities for Canadians aged 55 to 64 increased to $315.7 billion in the first quarter of 2024, up from $244.2 billion in 2020. For those 65 and older, mortgage debt also surged from $97.2 billion to to $141.2 billion over the same period. The increase in mortgage costs is largely due to interest rate hikes by the Bank of Canada between March 2022 and April 2024. The rising costs are squeezing household budgets, with accommodation prices up by 25.3% between July 2020 and July 2024. During that same time, mortgage interest costs soared by 46.2%. These increases are forcing many Canadians to rethink their retirement plans. Canadians of retirement age who have a variable rate mortgage or have had to renew in the last 2 years have faced higher monthly costs to stay in their own home. StatCan noted. Some homeowners have chosen to downsize or transition to renting to manage their expenses more effectively. A labor force survey supplement from June 2023 revealed that more than 1 in 5 Canadians aged 55 to 59 are either partially or fully retired. However, financial considerations are delaying retirement for many others. More than a third of men, around 35%, and over a quarter of women, about 28.2%, said financial factors were the main reason they had not retired. This financial strain is not limited to those nearing retirement. StatCan found that more than 1 in 5 seniors, around 21%, aged 65 to 74, were still working in 2022. Nearly half of those seniors were working out of necessity, many holding full-time jobs, with renters more likely than homeowners to continue working due to fewer financial resources. The survey also showed that 40% of Canadians aged 55 to 64 and 28% of those 65 and older reported that rising prices were significantly affecting their ability to meet day-to-day expenses. The cost of food, transportation, and healthcare all saw notable increases, further straining household budgets. The report also highlighted challenges around retirement savings. Pension coverage for paid workers dropped slightly to 37.5% in 2022. And contributions to registered retirement savings plans, or RRSPs, declined by 3.4% from 2021. However, nearly 58% of families contributed to at least one type of registered savings account in 2020, up from 52.3% in 2009. Despite these savings efforts, households in the lower 60% of the income distribution have seen their net savings decline since early 2022. While wealthier households have continued to save more. The ability to save for retirement has fluctuated, with many Canadians trying to balance rising costs with preparing for the future. A study from StatCan suggests that Canada's labor force participation rate, which has been gradually declining, will continue to fall until the 2030s, when the last baby boomers turn 65. By 2041, it is projected that about 23.1% of the labor force will be aged 55 and older, with immigration expected to play a key role in offsetting the shrinking workforce. As Canadians face the challenges of managing higher costs and debt in retirement, many will likely remain in the workforce longer, delaying their plans for financial independence. Canada's housing market is experiencing a renewed sense of optimism as interest rates begin to ease. While challenges remain, early indicators suggest that the market is headed toward healthier territory. In its latest Housing Market Outlook report, REA Max said that average home prices across the country are expected to rise between 1% and 6% by the end of the year, signaling a gradual return to more stable conditions. The fall market is usually a good early indicator for activity as we look ahead to early 2025, and we're headed toward more healthy territory, REA Max Canada President Christopher Alexander said in the report. With interest rates starting to ease, buyers are beginning to come off the sidelines. However, Alexander noted that while there are signs of recovery, the market will not immediately return to pre-pandemic activity levels. That's not to say the fall market will be in full swing according to historic standards, he said. Consumers will drive that trend, so we'll need to see a bigger move by the Bank of Canada for that to happen. The recent shift in interest rates has sparked optimism among first-time homebuyers. A ledger survey conducted as part of the RE Max report found that 1/4 of Canadians, or 25%, are actively saving for a home, with the highest confidence seen among millennials and Generation Z buyers aged 18 to 24. The easing rates are making homeownership more accessible for this group. However, not all current homeowners are benefiting from the rate reductions. 14% of survey respondents said they face mortgage renewals in the coming months and are concerned they may need to sell their homes due to the impact of higher interest rates. Though borrowing is becoming cheaper, RE/MAX pointed out that housing affordability remains a significant issue. Many Canadians are prioritizing daily living expenses, such as utilities and food, over home purchases. A substantial number of people, 28%, are even considering leaving the country due to housing costs, while 25% are reconsidering whether to start a family. Despite some consumer confidence starting to return to the market this season, the reality is Canadians are still grappling with some serious housing affordability challenges, rooted in a lack of supply, Alexander said. Borrowing may be getting slightly cheaper, but this will not make housing affordable in the long run. Markets ebb and flow, and as buyers re-enter the market and absorb inventory, we'll see more upward pressure on price, Alexander added. Ultimately, for the long-term health of Canada's housing market, we need a national housing strategy developed in collaboration between all levels of government that's more strategic and visionary in how we can use existing lands and real estate to boost supply. RE/MAX brokers across the country are forecasting steady increases in sale prices for most regions. In cities like Vancouver, Calgary, Halifax, and Winnipeg, average home prices are expected to rise between 1% and 6% by the end of 2024. However, certain markets, such as Toronto, Hamilton, and Burlington, are projected to see moderate price declines of 2% to 3%. The number of listings has also seen an uptick in most regions. According to the report, 82% of markets recorded an increase in listings between 2.3% and 34.7% from January to July 2024. Sales transactions followed a similar trend, with growth seen in Atlantic Canada, Western Canada, and most parts of Ontario, although some larger Ontario markets like Toronto and Brampton experienced a decline in sales activity. As the fall housing market progresses, RE/MAX anticipates continued competition in about a third of markets, which are expected to remain sellers' markets. However, this dynamic could shift as interest rates continue to decrease and buyer activity rises. Toronto's housing market may have seen a steep decline from its former glory, but buyers still need to earn more than a hefty $200,000 per year to be able to nab the typical house or condo in the city, which still averages around $1.1 million even while no one is biting. Those who were holding out hope that a dearth of sales activity might foster greater affordability will likely not want to hear that prices in the region are only starting to heat back up for some homes. But there are still many places in the province where one can easily buy a property for under the dreaded $1 million mark. In its fall 2024 forecast, realty giant RE/MAX says prices will creep up in most parts of Canada, except for places like Toronto, Hamilton, Burlington, and Kitchener-Waterloo. Unfortunately, the 6 and other Greater Toronto Area cities are perennially overpriced, even amid a market downturn, so this does not mean much for the average buyer. However, the firm does predict what properties will cost in various parts of the province by year's end, and shows where they will still remain cheap by Toronto standards. While a Toronto home is anticipated to cost around $1,093,483 when 2024 comes to a close, homes in nearby cities like London, Peterborough, and Niagara will be going for much less, RE/MAX's experts say. More northerly places like Timmins, at $277,217, Thunder Bay at $392,569, and Sudbury at $506,435 will, as always, be the least expensive. But Windsor at $579,260, London at $650,553, Kingston at $661,462, and Ottawa at $687,040 are also set to boast average price tags under $700,000, less than most downtown condos. Prices in Muskoka, Niagara, Peterborough, Kitchener-Waterloo, Hamilton, Barrie, and Durham region are also slated to stay under 7 figures by New Year's. Muskoka and Peterborough are both expected to see average prices of $711,769, while Niagara is close behind at $701,731. Kitchener-Waterloo will average $750,335, Hamilton at $785,308, Barrie at $806,606, and Durham Region at $943,240. Still, many Canadians are justifiably pretty low on hope that they will ever be able to own anything in this country. Despite some consumer confidence starting to return to the market this season, the reality is Canadians are still grappling with some serious housing affordability challenges rooted in a lack of supply, Arimax writes. Yes, borrowing is becoming less expensive, but this will not make housing affordable in the long run.